Whether you like it or not, lately your newsfeed was very likely plastered by news about GameStop's stock shopping frenzy followed by outrage about the favorite app of all stay-at-home gamblers, Robinhood. But this video is not about GameStop, it's about Robinhood and how does it make money. And let me be clear, most of the following applies to most of the other commission-free trading apps such as eToro, Webull or TD Ameritrade as well. But because Robinhood by far leads the scoreboard for the most public fuck-ups among all of these, this video is dedicated to them. So, let's start with a simple question. If Robinhood offers commission-free trading, how the hell do they make money then? Well, there is a saying that there is no free lunch on Wall Street. And even though CEO of Robinhood, Vlad the Stock Impeller Tenev, tries hard to convince you that Robinhood is here to democratize the world of finance and help the little guy by leveling the field with the big greedy Wall Street, in reality the intentions might not be as noble as Vlad wants us to believe. So what are the revenue streams? Let's see what Vlad has to say.
We generate revenue in a number of ways: Robinhood Gold, order rebates from market makers, stock loan, interest on cash, and now interchange from debit card transactions.
Alright, so basically the three main ways in which Robinhood makes money is through Robinhood Gold membership, securities lending program, and then whooping 70% of revenue comes from payments for order flow. Sounds vague? Yeah, that's probably by design. So let's break it down and find out what these things really mean. Robinhood Gold membership subscription is the most straightforward and easy to understand. For $5 a month, customers unlock extra features such as stock analytics from Morningstar, after-hours trading, and most importantly, buying on margin. What investing on margin means is that customers can buy stocks and call options for money borrowed from Robinhood, pretty much in the same fashion you'd pay for your groceries using a credit card loan. Doesn't sound like a recipe for disaster at all, huh? Well, Gold membership makes about 15% of total revenue sources for Robinhood. Now, let's talk about the next revenue source, which is securities lending. And that's where things get more interesting and much more opaque for their customers. Do you remember how I said about 10 seconds ago that with Robinhood Gold membership, investors can buy stocks using money borrowed from Robinhood? Well, there's the catch. When you buy options on margin with Robinhood, you as an investor don't really own any shares. Robinhood does. The only thing investors really own is commitment from the broker. Sure, Robinhood provides investors with many ownership rights associated with the underlying security, such as dividend payments or voting rights, but technically it's the broker who owns the shares if they are bought for, well, broker's money. And as such, Robinhood can treat these shares as their own to some extent. This means that they can, for example, lend these shares to whoever is willing to pay for renting them. And you better bet they do so, and more often than you would imagine. Securities lending made up about 15% of Robinhood revenue at the beginning of 2020, as reported by Forbes. Now, why would someone rent shares of a company, you ask? And the short answer is to short it. When someone wants to take a short position in a company, what they really do is sell stocks without owning them. But selling shares without borrowing them from somewhere, also known as naked short selling, is prohibited. And that's where Robinhood comes in. Short seller asks brokers such as Robinhood to go and find any shares available for rent, where the price of renting is based on the availability of these shares. And that's when Robinhood takes shares you thought are yours and lends them to these short sellers whose only aim is to drive the price of the company you invested in down so they can eventually profit on the decline. All the while Robinhood keeps the renting fee that would normally go to you. You see what's happening here. Your shares that you bought and as such bearing all the risk that the price will go down are rented out for a fee to other investors for the sole purpose of driving the price down, and you get nothing out of it. Robinhood does. Oh yeah, and the other investor betting against you if he successfully manages to drown the price. Now, if you are outraged that you never gave consent to anything like that, sadly you probably did when you agreed to those terms and conditions nobody ever reads upon signing up. Sounds shady? Well, wait, we haven't talked about the actual leading revenue stream for Robinhood. Let me introduce you to payment for order flow. The bread and butter of Robinhood's revenue they don't like to talk about that much, but more about that later. According to SEC filing, out of 130 million in revenue in the first quarter of 2020, 70%, which is about 91 million, was derived from selling its order flow. That only doubled to 180 million in the following second quarter, thanks to the mighty combo of the pandemic, stimulus checks, and gamification of the whole Robinhood platform. Just for comparison, E-Trade derives 70% of the revenue from payment for order flow, while Schwab only 3%. Talk about enthusiasm here. But what actually is this payment for order flow and why would someone pay a big buck for it? Well, believe it or not, Robinhood, just like many other commission-free brokers, don't handle the actual matchmaking of buyers and sellers themselves, but instead employ a third party to do that for them. Those are the guys often referred to as market makers, and their job is to find a buyer for every seller and vice versa. In practice, These are basically tech companies specializing in high-frequency trading, using an arsenal of sophisticated machine algorithms that execute thousands of trades in microseconds. In other words, their service provides a lot of liquidity, which is a good thing, right? And yes, up to this point, it sounds like these market makers are actually doing a pretty solid service to Robinhood. In fact, it's not uncommon for market makers to even offer a price improvement by giving slightly better prices than other markets or exchanges. So why the hell these market makers pay Robinhood for routing their customers' orders to them instead of the other way around? And the answer is money. Heaps and heaps tons of money they shave off of customers' orders on every single transaction that goes through their systems. One way of making money here is to profit on the spread, which is the difference between the bid and ask price. From every single trade, market makers shave off pennies, which might seem negligible at first glance, but significantly adds up with millions of trading volume. The prime cash cow here is especially option trading, because options are less liquid than stock and tend to trade at higher spreads. Even though Robinhood claims that only 12% of their customers trade options, those trades accounted for 62% of Robinhood's order flow revenues in the first half of 2020. Just for the picture, according to the report by Piper Sandler, Robinhood gets paid by high-frequency traders 58 cents per 100 shares for options contracts versus only 17 cents per 100 shares of equities. But the real elephant in the room is another aspect of payment for order flow practice. You see, when Robinhood routes customers' order to high-frequency traders like their buddies at Citadel and VRQ Securities, it is like your secret written on a piece of paper is sold to someone who has a monetary interest to trade against you. When someone handles your order flow, he knows exactly what your intentions are and acts upon them microseconds before you. It's like a peek to a future that gives away an early indication of market direction before it actually happens. If the high-frequency trader knows how many buy or sell orders are lined up at each price point, they can buy or sell microseconds before you, or even better, front run you by buying the security you aimed for before you and sell it back to you for more in the blink of an eye. Ironically, high-frequency traders like Citadel screw retail investors the most on the Robinhood feature that is supposed to protect them, which is stop-loss limit orders. According to Thomas Peterfy, the founder of Interactive Brokers, stop limit orders are the most valuable orders algo trader can get. You see, when a market maker sees there's a bunch of sell orders around a certain price point, what it means is that when stock or option hits that price, the market is going to fall hard. With such knowledge, a high-frequency trader can decide to go short, trigger the stop loss, and then cover at a much lower price. So despite in recent GameStop saga had a few retail investors trying to wage a holy war against hedge funds, the sad truth is that chance of winning was very thin as long as retail investors' orders were exposed to big players. Now, let me be clear here. Robinhood didn't invent payment for order flow, neither is the only broker out there taking advantage of it. Despite it being a controversial practice that is not allowed in Canada or UK, in the US, it's a legal way of conducting business as long as brokers follow certain rules. One of them requires brokers to disclose their financial relationship with market makers as mandated by SEC in 2005. Another rule is to give customers the best possible execution. However, turns out that Robinhood failed at both, and not by an accident, but more like by unscrupulous lying. Between 2017 and 2018, the official Robinhood FAQ page stated that gold upgrades and cash interest are the sole revenue stream. However, a recent SEC investigation found that payment for order flow has been Robinhood's single largest source of revenue since Robinhood's launch in 2015. But somehow boys Vlad and Bat failed to mention any of that. And what about the best possible execution for customers' trades? Well, turns out that despite Robinhood's claims that the quality of execution matches or beats the competition, in the reality SEC found that Robinhood provided inferior trade prices that cost customers $34 million even after considering the savings from not paying a commission. Further SEC investigation revealed the real reason for such inferior prices. Robinhood insisted on receiving 80% of the price improvement contrary to the customary 20% market makers normally pays for order flow. According to Morningstar, Robinhood was explicitly warned that the more they demand, the less will be left for the actual price improvement that would benefit the Robinhood customers. The company accepted those terms. That eventually cost Robinhood $65 million in a civil penalty filed by SEC in December 2020 for misleading their customers. There you have it. Story of Robinhood who robs the hood when nobody is watching. Besides the saying about free lunch, there's another one that comes to my mind. If you don't pay for the product, you are the product. And that applies tenfold for Robinhood and their customers. Despite the public narrative that Robinhood's customers are millennial retail investors, the reality is that the real Robinhood customers are the market makers, such as Citadel and Virtu Securities, while actual retail investors are more of a fodder for sharks. Now, that does not mean that as a retail investor you can't make money on Robinhood or other commission-free brokerages. If your investing strategy is buy and hold for long term, most of the above mentioned won't probably affect you that much. Well, except for the fact that you are probably getting slightly worse rates in a great scheme of things. But for anyone else, just brace yourself and know that you are in a nefarious fight. Thank you for watching and don't get robbed.